Hello, this is the chart profit video just before the open on Friday 16th of September. Last week we were looking at this chart. It's a chart of the spider. This was pre-open last Friday the 9th, and we were talking about the Bollinger Bands, 40 period Bollinger Bands. We were talking about this squeeze between the upper and lower Bollinger Bands. We were talking about the incredibly low volatility in the market, and I said that the Bollinger Squeeze was the tightest for years, and this will often lead to violent price action. I also said don't become complacent and think the low volatility could continue. We're probably going to see a violent breakout one way or another from here, and that's why this level, I was talking about 21.80.50 on the E-mini, needs to be monitored carefully. Actually, later that day on the Friday, we did see quite a violent break, an increase in volatility, and we saw happened to be down. The E-mini opened below 21.80.50. Let's look at that on the September contract that we were following at that time. 21.80.50 was approximately up here somewhere. We opened below that on the Friday, and then we saw the big sell-off, and I marked aggressive selling here. Bit of a recovery the following Monday. Tuesday, Wednesday, we saw lower value areas, tight value areas lower here, taking it down to the 21.20s. Saw a little bit of reactive buying. I had to mark yesterday on Thursday, and we've been talking about the resistance, first level resistance at 21.42.25. That's the half range. Doesn't seem apparent on this chart, but that's actually the half range off the August high on the December contract we're now currently following, and that level comes in here. And as I said yesterday, we did probe above that very slightly, very briefly. But if I show you now the current daily chart for the E-mini S&P December contract, there's that halfway point, the dotted line in there. And we know, don't we, that after a sell-off you'll mark the high and the low, and very often in a market with a bearish bias you will see that halfway point retracement. That's a common occurrence, so we have to be careful of this line. So price back above 21.42.25 on the December contract, and printing time above that level, consolidating, would be a real positive. Price as it is at the moment here below that level I think is weak price location. The big support on the chart is the major point of control support at 20.87, which is down here. As I mentioned this week in the pre-open, the breadth has deteriorated. If we look at the two bottom indicators here on our daily breadth chart for the New York Stock Exchange, this indicator here is based on new highs, new lows. I call it the net new highs 25 indicator, and that's a 5-day moving average. And if that is below zero, and this bottom indicator, which is the percentage of stocks in my New York list, if that is below 50%, then these two together, these negative indications, give us this red indication here on the daily breadth, middle part of the pulse chart here. And with momentum below zero and heading lower, this chart has actually deteriorated quite a bit. It will sometimes do that in an uptrend before turning around and heading back up. Occasionally it does that. Sometimes there's a violent dip, sometimes there's not. But this should compel us to be a little cautious here. There's big support on, as we just mentioned, on the E-mini, and on the spider comes in at 209.90. That's the major, as I call it here, time support. Price below that level would obviously be a much weaker position. We talked about the deterioration or the falling momentum divergence here between price up here and the indicator down here, and now it's turned red, so I'm just a bit cautious in the longer term. As long as we stay above 209.90, chart is in a long-term strong price location. I'll quickly review the sentiment indicators. This is my version of the Ridex assets ratio, and it reached a level here, 7.9 on the 26th of August, which was up here somewhere, just at a 7-month high. Worth noting, I said at the time, Ridex ratio hasn't fallen with this sell-off in the S&P by very much at all. In fact, on Monday last week, as the market rallied back a bit, the Ridex ratio reached a 10-day high, and as I said at the time, suggested the Ridex traders were buying the dip, and that's a little worrying. As we know, the bull fund assets in isolation, I'm looking at here, reached a 7-month high at the same point. And the bear fund assets, if we look at those in isolation here, still at a really low level, indicating, and there's certainly been no pickup here in the bear fund assets. Again, that's just a little worrying. In the public poll from AAII this week, the bulls percent was lower, 27.9, and the bears percent actually jumped a little, 35.9% from 28.5. So more bears than bulls this week. You can see it in the negative little histogram on the right here. 4-week moving average of net bulls minus bears in pretty neutral territory around 0 here, and certainly, although there's more bears than bulls this week, nothing extreme. In the Investors Intelligence poll, the bulls percent was lower at 49%, but we know that 3 weeks ago the bulls percent reached 56.7%, and that was the highest since May last year. So at this point there was measurably a high number of bulls in the market according to this poll, and just 4 weeks ago bears fell to 20%, and that was a 12-month low. Again, we can see that in the 4-week moving average of the net. Just 2 weeks ago that reached its highest level since May last year, back over here. If we look at the exposure index, which measures current equity exposure of active money managers, this week that fell quite sharply. It was down at 68.55 here, and that fell from 90.85 the previous week. So that was a fall of 24% in 1 week, and I've just marked on the chart here on the S&P these arrows indicating previous weeks where that has happened, where this indicator has fallen 24% or more in 1 week. And interestingly, it acts well as a contrarian indicator and does tend to mark the point where the market starts heading back up. So we have bearish, or a real increase in bearishness amongst money managers here, a contrarian indicator, some evidence that the market may want to come back. I look at the Ridex data, which is a measure of public sentiment, and would much prefer it if that public sentiment indicator was actually confirming this. Currently I'm not seeing it. However, just to throw another public sentiment indicator into the mix, this is the GBPUSD fund flows. They reported equity fund, including ETF outflows this week of 14.4 billion. That's an outflow in the week to the 14th of September. That's the largest single weekly outflow in 12 months. So there you have a little retail fear showing up in this indicator. Price itself being the most important indicator, and definitely want to see the E-mini back above 2142.25 before looking at the long side. As I said earlier in the week, the alternative strategy to that for me would be a test of 2087, a rejection, and some aggressive buying or effective buying marked above that level. That could also get me interested in the short term in the long side. Okay, I'm now going to review some of the charts. Market's not long open. We're just a little into the trading day. This is the Russell 2000 ETF IWM, and the support on this chart has been for a while. The first level support, the 3-month at 119.57. Price below that level would suggest a retest of the major down here at 115.35. But in the long term, as long as IWM holds that level, it's in a strong price location. Personally not interested in new longs unless we see price back above this halfway point here, and as you know, I'm monitoring that, which could be a movable level if we see a new low. I'm measuring and monitoring that level day to day in the pre-open. Tech is the relative outperformer at the moment. This is the Qs. If you look at XLK, you'll see the same thing. It's come back really strongly this week. There's a 4-month at 116.97, so this is a good chart to follow, and it's there. Currently we're just holding above that level, and you can just see from the shape of the chart that this is the relative outperformer at the moment. UK FTSE 100, we have a 4-month at 67.23, which is very close to current price action. FTSE was attempting gains earlier in the day, just off a little bit at the moment. So there's that sell-off a week ago on the Friday. Here's the Monday, and we've not really seen much of a bounce here. But price holding 67.23 to the close in early next week would be a minor positive sign for the chart. The FTSE large cap index holding up better than other European indices. You can see the DAX here and this is an interesting chart. We showed the 3-year value area high in here. So we look at the range over the last 3 years, calculate the point of control, which is down here, 97.50. The value area high on that chart, which has been probed twice and rejected, is up here, and looks like we're on the low of the week right now. Talk in a moment about the likely reason the FTSE's held up so well today. Discuss that a little later on. Spend some time talking about this chart TLT in recent videos, and in the pre-open we were looking at the level that we always watch from the top to the first low and the halfway point, and the rejection here, here and here, and again here. I did mention this earlier, from a high to the first low you measure that halfway point. Doesn't matter if it gets taken out there, it's where it finds the resistance. It's a weak pattern. There was a lot of time here spent below that halfway point in consolidation, and we've seen a violent fall late last week and this week. Seeing a little bit of a rally today, but this is weak price location. The only really clear support is this one here at 130.77, which is the 3-year. It's likely to be more volatility going into next week, mid-week. So who knows, we may see this come into play. We've been talking about this chart as this is the gold shares, GLD, gold ETF. Talking about the similarity to the DAX chart, believe it or not, the 3-year value area high up here that got probed twice, corresponding point of control down here at 118.22 as part of that distribution. I've mentioned there's a possibility that point of control could move higher with time in this kind of area. Hasn't done that yet. I'm monitoring for that. Gold's not had a good few days. You might have expected, with some fear emerging, that there may have been some buying in gold, but it hasn't really materialized, which is maybe a concern. Should never really try and tell an asset or a security what it should be doing, but been no kind of safe haven bid at all for this particular asset. I suppose the strength in the dollar, recent strength in the dollar, not helping the chart, but calling this a weak chart. Price back above that mile and a half, wherever that moves to, would be first sign of strength with price where it currently is. Here is the dollar index. It's popping today. It held, as we discussed last week, the 2-year down here, 94.76. So that looks like a kind of higher low, possibly on a point of control, but price up here above this halfway point would be the strong price location. So currently we're sitting between this support and this resistance, this half being off this high to this low, and you can see it's proven from that little point there. So as far as the index goes, that's where we are, between these two levels. Let's look for clues in the other charts. This is the Euro FX chart, sitting right on the 4-year support that we've talked about quite a bit, at 111.65. There's a halfway point underneath that, so this would be an area of support here. And price below this level would be really weak price location, and suggest that the dollar is doing rather well if we see that kind of price action. This halfway point off this important low over here to this high, and right now we're sitting right on the 4-year. And finally we look at the pound dollar, and first of all this chart probably explaining why the FTSE 100 is relatively outperforming today. UK large cap stocks most likely to outperform with a weak pound, and that's what we're seeing. So this was the Brexit sell-off here. We made low here, the subsequent high came in here, and as we've discussed, the halfway point comes in at 130.137 here, and we have a point of control. We had a point of control minor emerging there, and it still sits there, and so we have some kind of bell curve, as I mentioned the other week. As you can see today, at the end of this week, the pound is rather weak, and it's actually printing below that level. If I zoom in, we're looking here at an hourly chart, and you can see just 2 days ago there was exact support off that level, 131.37, halfway point, minor point of control. So it's proven support. We had a rally. I thought, oh, okay, this is interesting, and now at the end of this week, we've faded really badly, and we sit in a really weak price location now for the pound at the end of this week.